Just give an introduction about Nick. So Nick is a mathematician and finance professional with over 20 years experience in research, structuring, trading across buy-side and sell-side firms. Nick has worked at Lehman Brothers, Deutsche Bank, Nomura, Goldman Sachs, Citadel. He specializes in area ranging from quant strategy, relative value trading, to asset allocation. Currently, Nick is working at mid-frequency prop firm based out of Chicago. He is also honorary professor at University of College London. Nick developed the algorithmic trading strategies course, which he has taught PhD and MSc since 2016. Chris has co-authored the book Managing Uncertainty, Mitigating Risk, which addresses the uncertainty in modeling financial crisis. He holds a PhD from Courant Institute, NYU, with a postdoctoral position at the University of Minnesota. And before moving to Wall Street, Nick held a tenure track assistant professorship at University of Illinois. So in today's webinar, we are going to discuss about how to use a Ganger's causality and how it is used in and how its extension, including time varying Ganger causality, to test whether one time series can meaningfully forecast another, helping us identify robust predictive features, eliminate noise and spurious signals. Now I will hand it over to Nick.
Okay, thank you very much, Tarun. Hi, so as Tarun mentioned, my name is Nick Firoozye. I was formerly a mathematician teaching. I moved to finance over 20 years. Is there a problem?
Sorry for the disturbance, Nick. I muted the guy. You can continue.
Okay, sure. So I moved to finance over 20 years ago, and then initially always doing quantitative methods, but only since about 2013 doing purely systematic. And since that time, I've also developed. I understood that systematic trading was actually something that had a. Let me just see if I can make the mic louder. And systematic trading was something that had a solid academic background. And so I started researching it and put together a very systematic trading. I found that actually it was something I quite a lot in my finance career since going to teach classes in UCL, PhD.
Nick, I think your voice is breaking a lot. Can you please just have a look at the network? Because your voice is breaking a lot.
Yes, I can't. So since classes, so today this is some material that I put together that hedge funds,
Nick, we are not able to hear you. We are not able to hear you, Nick. We are not able to hear you.
So let's see if I can do this. Is this, can you hear me now? No. Is it any better? Nope.
Much better.
Hello? Is it much better?
Yeah.
Okay. Oh, good.
I think
All
we
right.
are getting
Yeah, we can hear you now.
feedback.
Okay. So now I need to but you hear feedback at the same time.
Earlier, we were getting feedbacks from your
Oh,
speaker, and I think that got cut out now. Much better.
Oh, cool.
Thank you.
Okay, good. I'm glad to hear it. This is still, everything here is still unfortunately somewhat tentative because I use my computer a lot, a tremendous amount, but hardly ever for meetings. So I have my daughter's computer just set up as a backup, but it's going to be hard to move. So let's hope this works. Okay, so this material is I was looking into causality in crypto, and essentially it's the idea of looking for what are reasonable features in a model. And so I'm going to take a step back and give you some material in that regard. So oh, I forgot to show you this. This is if you're ever interested in some of the material, this is my link tree. So if you look here, it's link linktr.ee MB Firoozye, and this has links to whether it's what is it? Whether it's, let's see, my GitHub repo. Not a whole lot of it is public at this time, but there are public repos for what we're going to discuss today, and as well as my personal page and blog. Personal page is a little too big here. Let's make it smaller. It's a little too much stuff in it. But here you can go to the blog, and I'm still in the process of getting it up and running. I've got a couple more things I want to publish on it, but this is the first. This is unrelated. Everything's related, but this is a different topic. Is trading mid-frequency using mean reversion and statistical tests. But at the bottom of it, I just wanted to point out this is something from one of my courses that I talk about. This is essentially, you could say it's a trading framework. And in the trading framework, we have data sources coming in, going to, okay, sometimes they go to a data store, sometimes they go directly to your, they're streamed directly to your models. But let's just assume that they can do both. They can go to the data store, whether it's market data sources, maybe it could be fundamental and macro, depends on your frequency, news, sentiment, things like that. Any sort of scrape data, everything goes in the data store. From the data, we clean it, we patch it, we fill it, we impute it, and things like that, and then we create features. Features or independent variables, if you want to call it in a statistical way. So the features get created and they could be stored in a feature store as a way of making things faster. If you're making back testing faster, but if you're looking actually at doing things on the fly and extremely fast, then you don't worry about that. You just do it quickly. Features get fed to alpha models, to risk models, and market impact models. And the three of them together form allocation models. And this is something I talk about. I'll give you some links to some of my online courses, but this is something we go through in some detail in the online course. Today, and so allocation, we have target allocations. We come up, we work on execution, and then we feed it through once again. Sort of separate to this is a performance reporting and risk management framework, which are somewhat they're not quite the same pipeline. Today, what we're planning on talking about is really is somewhere in between data and features and models. It's that little bit of it. We want to look at, we're interested in weeding through, there's so many possible features out there. We want to weed through those that are meaningful. And that's really what the goal of today's talk is to weed through the meaningful features. Now, if I got this up and running, this should all be in the GitHub repo, which I'll share with you. But we have causality analysis here, and here I've launched it once again. It's overused now. Okay, now, so this script is supposed to do analyze causal relationships between the major cryptos using Granger causality testing. So in order to do that, we have to go through what is Granger causality testing. And I should tell you, as a mathematician, I was sort of I had assumed that when I was going into finance that I would be doing stochastic differential equations and Black-Scholes and pricing derivatives and stuff like that. Now, not to say that I haven't done that, because I have, the primary focus of my background has actually been more statistical analysis, statistics, econometrics, signal processing, machine learning. They all fit into the same sort of general category of looking at empirical data. And that I found to be far more meaningful in the stuff I've done. And that's really what today's talk is about. It's actually some relatively simple statistical analysis called Granger causality. I have some links here, and this is something worth looking at. So it's just a Wikipedia page. The whole concept of Granger causality. It's basically analyzing leads and lags in statistical data. So the Wikipedia page is not bad. And essentially here's for instance X and Y two time series, and the claim was that X causes Y because there's a you could see some of the movements in X sort of precede the movements in Y, and it seems to have a regularly even sort of spacing between the two. X Granger causes Y, and it's likely that Y does not Granger cause X, and that kind of asymmetry is kind of an important thing. Reading through causality is important because then if we want to forecast Y, we can use lagged values of X to forecast Y. Now, this is actually really important because there's a lot of times out there we look at correlation in financial markets, and people are looking at correlation. Yeah, it could be. So NDX, actually, I don't know what is NDX. But yes, absolutely. What is altcoins and Bitcoin, altcoins and Ethereum. Ethereum and Bitcoin do their own thing. So if we jump to the chase, but the altcoins are less liquid, and they're typically thought of as being caused by the more liquid ones. And then this is how to look for those sorts of relationships. Now, Granger causality is actually quite simple. It's really just based on an F test, and let's see, what do we have it? Do we have it in here? Okay, here's a simple version. Okay, we assume that there's an auto regression for Y, and I'll look at the actual application in terms of the notebook. But here, Y has some AR model. This is an ARM model. It is forecast by lag values. Now, what we could do is we could stick in lagged values of X, and then the question is which model works better? And of course, if it's just R squared, the thing with more regressors is going to always work better. But we can actually do a statistical hypothesis test for this. And hypothesis tests for regressions are really quite simple. So if you want to test the significance of a single variable, it's typically that you would use a t-test. So where the t-test will follow the student t distribution, and you can use that to establish whether it was significantly different from zero or not. But here, because we have multiple coefficients we want to test for whether they're zero or not, then we want to look at what's called an F test. And an F test, again, it's something that's really very simple. It's in every major statistical package out there. If you're using Python, you can use stats models. You'll find F tests in it. There may be F tests around many other places. I mean, typically I use so of course I like scikit-learn and things like that, but they don't allow you to get deep into the heart of each model. So for linear models and for much more simple models, not scikit-learn, but stats models allows you that kind of analysis. Is that coefficient different from zero? If I constrain the coefficient, what would happen? Things like that. Okay, so this is quite a good Wikipedia page, and let's go on through the actual notebook. Two other references worth looking at, and I'm really keen on references because I know anything you look at is worth studying in more detail if you want to implement. This is actually a pretty good reference. This is again, it's available online. It's just a review, and I guess there's some more recent stuff in Granger causality. I was asked once to do a Granger causality a consultancy once, but it had to do with multivariate. Something could cause something else, but not another thing. It was combinations. It was much more complicated, and you could see a bit of network theory going into it. So there are some newer. I'm going to make this smaller once again. Sorry, I have a very a very large screen here. That's anyway, this is definitely worth looking at. The links are going to be in this, which unfortunately I didn't actually put in the same repo. So I need to make sure I posted the same repo so you can get all the same analysis. And this then is actually quite an interesting paper by Koza and Unal, causal relationships amongst cryptocurrencies. And it's essentially looking at why is it that sometimes it's hard to establish that causality in cryptocurrencies. And it has a lot to do with the availability of data and the noisiness of the data. And sometimes the causality is harder to establish at really fine timescales and much easier to establish at longer timescales. Anyway, so that's quite a good paper, and I guess I have it open somewhere over here. There we go. And that's available to download as I put it in the same repo too. And actually, let me just see here. If you guys are following along, maybe I can just give you access to the repo right now. Let's just make sure here. Okay, so it's I want to get to the oops. So I'm over here. Let's look at the GitHub repo. So GitHub. Let's see. So. And here's my GitHub repo. It doesn't have a whole lot in it. I have to apologize. I do a lot in GitHub, but I don't make so much public. But let's see. So here's the Firoozye crypto causality. Oh, and some of this shouldn't be public, but I'm hoping not. But anyway, crypto causality should definitely be public. And this is something that you can all install, download, and we can look at together. And here, in fact, is the paper. I think it's one of these two papers, cryptocausality.pdf. This is the paper itself. So I'm sure you can find it online as well, but I put it in here just for safekeeping. Okay. I'm going to be putting more stuff in here over time, and leaving it public. Okay, let's go back here to this. Okay, now I'm going to start executing some of this. And now the other thing I didn't tell you about is one of the reasons for doing crypto is because there's an abundance of data. It's free. It's generally available. And I went to and you probably all know if you're interested in crypto. But if you I'm going to go here because I don't want to look at this again. But I think it's if you look at Binance, yeah, data.binance.vision. There we go. So Binance has a tremendous amount of market data, and it's really reasonably high quality. And there are other exchanges that do as well, but this is one that has a nice API. You can pip install the Binance downloading tools. It's really quite straightforward. But so here we actually have in Binance, and there's information on spot futures and options. We're only interested in spot right now. And then this is just about the size of the files you'll get. But so I think can't remember if I use daily or monthly. Now I can't remember what's in all of these, but we're interested in K lines, and K lines because it has a lot of information in it about high, low, open, close, the kind of stuff that people would be interested in following in doing trading. Now, there's of course a tremendous amount more information that would be great for us to have access to. I'm not sure if we can, like much more directional information, but it's not absolutely clear that we can. So we have like all sorts of strange coins in here at all different frequencies. I think I looked at the 1 minute, and I looked at the at lower frequency, higher frequencies, excuse me. No, higher, so lower frequencies. So it was 1 minute, 1 day, and so on. And so you see, you have a tremendous number of files in here, and it's very easy to download. And if you look at Binance, Python API, let's see that. There's this. This is where you look for, and I have in the repo. I have okay. Oh, there's actually a little bit. Oh, here we go. Python Binance. That's where to look for the information. Not here. I mean, you can pip install it from here, but or you can go to GitHub and go directly. But this is where there's lots more interesting information about the data itself. Oops, and I mean, it's so small I can't see it. Okay. So, so you see there's a lot of good information out there. You spot vanilla options or futures. And so we'll cut to the chase. I've actually implemented this. I gave it to the students in this hedge fund. They loved it. They changed the frequency. They did it multi-threaded, and they locked themselves out because Binance itself detects that kind of information. And then eventually they started mixing up their IPs and using VPNs to download. And eventually they had millions and millions of data points. And it's possible to do that just to get a good sense of how things really work and how you can get an idea of what the infrastructure really is. So in terms of that, let's see. I'm going to go back to my page here. Let's see. So this is unfortunately it's gotten very glitchy here, but this is let me see what I have here. So I have this something called in the repo is source.data.downloader. I'm just going to go out of the data repo. So this is the repo here. It's got a README in it. It's got the crypto causality.pdf. It's got some data where I store the data. I didn't store any data in the GitHub repo. And it's got let's see, the README. I'm not sure if it's entirely up to date because but it's an analysis of what the data structure should be like, right? And so I revised it actually with some visualizations, and now it's since been revised a little bit. So please don't blame me for making it for it not being fully up to date. But in the source files here, we have analysis data. This is a type of model, exponentially weighted recursively squares, some utils and visualizations. So under data, we have here the data downloader. And so the data downloader is what I was looking at right there. So let's go to let's go here. Okay, the data downloader just takes the Binance client, and then it now it's been a little while since I put it together, but I think it's that there's a config file, and it downloads all of these columns: timestamp, open, high, low, close, so the bars, and volume, close time, which isn't that interesting. The volume, number of trades, take or buy, base volume, take or buy, quote volume. Okay, so some of this is it'd be wonderful if it was directional. So if you have like buy side volume, the buy volume versus sell volume, or the bid versus the ask, that's a very important thing, rather than have non-directional data. And I'm not sure if that's possible in here, but it's something that just to let you know that for further exploration, if you can find directional data, it's much more meaningful. So the total number of quotes on the ask side versus the total number of quotes on the bid side. The total number of cancels on the ask side versus the cancels on the bid side, because people know that cancels are very, very important. So number of quotes, of course, is how you get, what is it called? It's, I use it all the time. But there's a word, the order imbalance is related to the quotes on the ask side versus the quotes on the bid side. But you can have the volume on the ask side versus the volume on the bid side, or the percentage of takedown, for instance, on each. Each of those is potentially meaningful. I don't use any of it in this specific class because what we're looking at now is just close. All we care about is close. We're looking at price data. Okay. But I just to let you know, there's an abundance of information. It may or may not be enough. Okay. Now, all the data that all everything that we look at here, I've put into the notebook subdirectory, into a Python subdirectory. Everything is it's called Python Notebook. Python notebooks are nicer because you can edit them in normal editors. You'll maybe like Visual Studio, or you like PyCharm. I have both, but I like Vim or NeoVim, and so it's just one way to. It makes it's much easier to edit it than it is to edit a notebook. And the thing about these is that you see I can create markdown cells. This is a markdown cell. It's another markdown cell. This is still part of the markdown cell, and this is just a regular cell. And then once you've done all these, you've created all these cells, these markdown and so on cells. Then over here, let's see. I'm going to go back to notebooks. So yeah. So it's in notebooks. Okay, so notebooks, I said I have my Python, my Python notebooks over here, and over here I have my Jupyter notebooks, and I have this thing called convert to Jupyter because I can never remember um, the exact. It's just a Python. It's just a what is it? Yeah, it's a Jupy text. I think that's something you have to actually that's what you have to let's see. Python -C import NB converts. Oh, so but there was something called Jupy text, I think is what it was called. Oh, there we go. Use Jupy text to convert properly. So Jupy text to notebook, the Python file output is a Jupyter file. So and you can convert back and forth, right? And so anyway, I have in here I have convert to Jupyter, and so you just convert them all. Every time I make a change, I convert it to Jupyter. And then if I want to make my change permanent, I keep it in my Python files. Okay. So we have all that. Then over here in our notebooks, okay, oops, that's not the notebook. Here's the Granger causality. Okay, I can reload it. It hasn't changed, I'll tell you, because I haven't changed anything. So let's see here. This is annoying. Okay. Okay, some of those notebooks, the crypto diffs exploration, the crypto exploration. Okay, I'm going to say where's the checkpoints? Let me just make sure. The checkpoints are things that just typically come along for free. Some of those were earlier versions, and if you get them working, that's wonderful, but you'll see they're somewhat more naive. And they don't, so there's, so what we're looking at causality analysis and causality analysis 1 hour this time. But we have the explorations in differences, and then the original exploration. I should just delete some of these, and then some QQ plots, and the forecasting model is potentially interesting. I'm sorry. Oh, let me just see here. Let me see. I guess I should find someone to. 1 second. Let's see if I can. Let's see if I know how to mute him. Oh, no. I'm sorry. I'm just trying to find a way of mute. This is Udairaj, and I don't know if Shivang he's not muted also. I don't know the way to hide him. I can pin. How can I mute? Oh, here we go. Oh, I'm sorry. So I was looking at and I'm trying to figure out how I can do that. Yeah, trigger on if you can, that'd be great. I don't. It's not really obvious how to mute people.
Sorry for the inconvenience, Nick. I have muted him. You can continue.
Okay. I'm trying to figure out, I don't even know where to start muting. I can see that he was talking, but there's actually a number of people who are unmuted, but they happen to be quiet, which is great. So, okay. So some of the notebooks here are potentially interesting in slightly different ways, but they're not really meant to be, to talk about today. As I say, for my class in this hedge fund, which is one of the major London hedge funds, I actually I gave them incomplete work, and I asked them to finish it, which they did, and they went far beyond my expectations. So in that sense, it was quite interesting, and some of these were really just the starts of some of their analyses. Okay, so let's see. So I've got all these notebooks here. Now, oops, let's go back here. Okay, So let's make sure it runs. That's the thing. I've been changing it, and I changed it a little too much probably. Oh, you see, I've already got some context there. Okay, and then okay. All that data I downloaded, I should tell you about. Excuse me, I actually there we go. So I'm loading all sorts of data, and the data I'm loading is Solana. I see BNB. I think it's Binance Coin. Cardano is ADA. There's Bitcoin. There's Dogecoin or Doggy Coin. I've heard it called as well. And then Ripple, Ethereum, and Bitcoin. Okay, you'd say that some of these are not necessarily that much altcoin at this stage, but clearly there's sort of an order of liquidity amongst them, but it's interesting to note that things have changed over time, and that's something we have the ability to explore. Now, for each of these, we want to just sort of make sure our data is up and running, and we want to create some some return series. And my return series are going to be here's log returns. Oftentimes I like to use just plain old price differences, just because it seems a lot easier in terms of, because sometimes you want to forecast price changes because you want to put money behind something the price changes. Eventually everything's gonna have to be in dollars and cents. So other people will put just normal returns, as long as you make sure that whatever it is, the weights that you have times whatever return series you have together, they give you a P&L. That's the important thing. Okay. So our first test is to look at pairwise Granger causality. So pairwise is identifies the potential causal relationships between the crypto, fitting a model of this form. So we have, oops, let's see, let's revert to the it somehow it liked that. Okay, I'm gonna not have to go through this because I think everything's still been loaded. Okay. So we did the pairwise crypto causality, and we can find here the thing that's a little bit surprising here, and that doesn't necessarily follow our intuition, is that at least for the most significant at the 5% level, we have that Solana causes BNB. Okay, that's fine. That's not very liquid. Doge causes BNB. Ripple causes BNB. Doge causes ADA, and Cardano causes Ripple. Surprisingly is that none of the others are in here. And so our expectation, I can tell you we have a very strong prior. The prior is that Bitcoin causes BNB. Bitcoin causes ADA, and then Ethereum causes ADA, and that Ripple may be its own thing. And then Doge also had some ups and downs that were relative to what Elon Musk was doing. But so knowing that kind of information is quite important, because you have to have a prior, and that's one of the important things, is to have your prior, to test your prior and see if it really how it really works. Now, okay, so then we have a visualization, just looking at a digraph visualization. Let's see how it works. Okay, so in our little thing, we have that Doge causes Cardano causes Ripple. Ripple causes Ripple causes Binance Coin. Doge causes Binance and Solana. Okay, but one right now that looks like we're probably going to be able. We may very well. Looks like the one that we might be best at forecasting would be the Binance Coin, using lags of these: lag Solana, lag Ripple, lag Doge, and then if we wanted to, maybe we'd be good at forecasting ADA using lag Doge as well, or forecasting Ripple using lagged Cardano. But one way or another, we have some sort of causal structure here. It's not our expectation, and this is an important thing, is that according to this paper, is that a lot of the statistical hypothesis tests are very challenging when you have actually much more crypto data. Crypto data is just so very noisy and jumpy that perhaps you could say it doesn't really follow the standard statistical distributions that one would expect. On the other hand, if you look at crypto data on a lower frequency, like hourly or daily, it's a different picture altogether. And that's something that I'd say my students actually had a lot of interesting results on, and came up with some very interesting relationships based on that. Now, okay, the other thing that's to point out here is this was a very, very simple kind of model that we were testing. We were testing basically, it's just a bivariate model. We had like, you have like Ripple over here as the X variable and Cardano as the Y variable, for instance. And that's all you're testing. But in reality, you can have potentially more complex models where you have more lags, you have more other variables, you have the other crypto. And so far we're only looking at pairwise relationships. And just to let you know, it was Clive Granger who came up with this, which is why it's called the Granger Causality Test. Granger, of course, was a Nobel Prize winner with Engel. Engel and Granger also did the whole concept. They looked a lot at non-stationarity, which is a very, very important feature of financial time series. And they looked at things like co-integration, so mean reversion and co-integration. Again, sort of the basis for quite a lot of very interesting trades out there. And of course, they did the Arch-Garch framework. There's just a tremendous number of things they've done together. But this one, I guess, Granger did on his own, and it's called the Granger Causality Test as a consequence. Now, the other thing I hid in here was I told you that it's an F test, and you're trying to test whether these gammas here, these gammas are significantly different from zero. But you see, there's a potential F test for every P and for every Q, where the P's and Q's are based on the lags of the series itself and the lags of the thing you want to look at whether it causes it or not. So if this was Cardano as the X and Y was Doge, then we don't know how many lags to do of Doge and how many lags to do of Cardano. The way we do that, and this is very, very typical, is to fit a range of these models for many different lags, and then to use something called the Akaike information criterion or the Bayesian information criterion as a way of determining what's the optimal number of lags. Now, AIC and BIC are both kind of, you could say they're similar to adjusted R squared, that they're both ways of looking at what the goodness of fit is relative to the number of extra parameters you put in. So just like an adjusted R squared would, except adjusted R squared doesn't actually have any theory behind it.
और तुम्हें साल तकिया पे कौन हो गया
अभी तो मुंह पे तभी नहीं लगाया भाई मुंह पे लगाया था अच्छा लगता
Oh no. I think I need to find a way of muting everyone, and then we unmute only if we need to. Let's see. I'm just gonna look one quick moment here whether I can do that. There must be some way. Mute, maybe under my mute. No, looks like I can only mute. Okay, doesn't look like it. Anyway, we'll find it. We'll hope for the best right now. Okay, so so essentially we have as I said, so we have the AIC and the BIC, and we can use one of the two of them as a way of determining the optimal number of lags. Once we determine the optimal number of lags, we can then do the hypothesis test, and that's the standard method for doing it. It's a standard method for how you do stationarity tests. A standard method for a lot of things where there's many variants of a test that are possible. So this one then. Okay, so we don't have a whole lot of range here. We can test many more lags. We can test at different significance levels. It's possible to do a number of things here. So this is the version that I did here. I did max lags 3 mostly because I was interested also in what's called in something called the multivariate causality. Okay, so now multivariate causality is sort of the next level of complication when it comes to Granger causality tests. Multivariate causality is basically saying that we're going to try a model with many possible variables in it. And here, let's go back to the Wikipedia page because it actually gives. So in the multivariate, let's see if we get rid of this. In the multivariate causality, okay. We fit what's called a vector autoregression, and it doesn't actually explain it that well. I mean, it's in here if you pay attention. But what it is essentially, if you look at this bivariate one, we had y versus y plus x. But now suppose there's in the multivariate version, you could have say y and z as the thing you're testing against, and y and z versus x. So, like for instance, maybe you want to test that whether Cardano is caused by you say you want to is it caused by Doge? But what if is it caused by Doge if you also include Bitcoin? So if you include Bitcoin and Cardano, so you have lags of Bitcoin, lags of Cardano, and you put in lags of Doge, and you want to test just the significance of the lags of Doge. And that's what the multivariate analysis is. And you see, you have many, many more parameters to choose. And so I quickly ran out of data. I can download much more data, but then it just takes more time. But that's essentially what we're doing here for the multivariate. And so it's a little bit more realistic, because in our forecast model, we'll also want to include other variables, other features, not just lags of Bitcoin or lags of Doge. Okay, so let's go back here. So in the multivariate, and again, so here we had, so this Bitcoin, okay, you see it's not Bitcoin dollars, Bitcoin versus stablecoin versus, what is this? This is a USDT. I just forgot which one that was, but it's one of the stable coins, and that's the exchange rates they give you. Now, what did we have here? Oh, and you know what? I seem to have screwed it up, because there should be much more interesting things in here than this. It's been a little while since I target crypto. And let's see, optimal lags, coefficient, test stats. Okay. I'm afraid that I made a change to it just a short while ago. And let me look here what the test stats are, because it doesn't really. Oops, sorry. Let me see what I did here. Okay. Multivariate causality, optimal lag 3. Okay. So it looks like they're oh, this is not, and in fact, this is not the one I wanted to do. Let's look at the other way. Let's look at something like Doge. Let's see if that works. Optimal lag 3. I know I'm just going to make sure for target crypto. And I changed it so I didn't go over too many lags, because I said I quickly ran out of data. And it looks like for forecasting Doge, it looks like, okay, that many of them are significant. Let me just go here. Oops, that should actually go like that. Oops. Okay, says the optimal lag is 3, and this isn't going to be very interesting right now. Okay. Okay. And we have at the various different significance levels. I did a 5% significance, but you see for forecasting Doge up to lag length of 3, Bitcoin and Ethereum are the most significant. Solana is actually reasonably significant, and then Ripple less so, because Ripple likes to do its own thing. And then we have Cardano, which is not, it's still according to this significant at this level. And we could potentially include all of them but if we want to whittle down the number of features we want to do, we probably would want to look at focus on those which we know to be the most significant. So in some sense, it's not fully I'd say it's not fully conclusive, and part of the reason being that we're looking at this 1 minute level rather than a longer so a slower frequency. Slower frequency is much easier to establish these kind of relationships and to see how they vary through time. Okay, but one way or another, this is the type of test we do again and again. for trying to establish whether we should include a feature or lags of another variable into ours. As I say, what's typically known is that a lot of things on lower time scales we see as being correlations on higher frequencies. They're actually lead lag relationships, and that's kind of an important thing because you can take advantage of lead lag relationships in a way that you can't quite. You can do much more than just a regular correlation. Correlation, of course, is great for diversification benefits, but but you can make much more money on exploiting lead lag relationships than you can on diversification benefits. Okay. So the last kind of Granger causality is time-varying Granger causality. And so in time-varying Granger causality, we recognize that that our time series are they're not just time-varying, they're non-stationary. And non-stationarity is a really, really important thing in finance, that things change through time and that the parameters that you had at one point in time are no longer the same parameters that you had long before. And there's lots of reasons for this. It's partly that markets evolve, and not just that markets evolve, regulations change, new instruments are introduced. I mean, there's lots of reasons for markets evolving. It's not just the people themselves, as though the people themselves all got smarter. Not necessarily. They just have to deal with more things, or a company goes out of business and you have a completely different data set. So there's all sorts of external reasons for this non-stationarity, and the non-stationarity changes our parameters through time. So stationary is a very important thing in traditional statistics, but non-stationarity is something we have to cope with in finance a lot. And as a consequence, there's something called time-varying Granger causality. And in time-varying Granger causality, we look at it. It's very much in the spirit of what's called adaptive filtering. If you guys know a little bit about signal processing, people study the most advanced sort of signals that people processing methods they study or filters they study are adaptive filters. Adaptive filters will typically have some sort of moving window. Types of adaptive filters are recursive least squares. Recursive least squares could be like a rolling least squares. I used to think when I first joined finance that was like a forbidden thing to do. Why would you ever, you have more data, you should use all your data. Well, in finance, sometimes you don't want to. Sometimes the history is really not relevant for today, or it should be downweighted a lot. So recursive least squares, you could grow your window as sort of expanding least squares. In Python, just as you know, there's something called there's ways of doing expanding windows for a lot of statistics, and but there's also rolling windows. Recursive least squares can be set up as a rolling least square, so you have a specific window that you roll through. There's something called exponentially weighted recursive least squares, EWRLS, where you just add more data, but you downweight. It's exponentially downweighted the history. And that's also a very good way of having an adaptive filter. Kalman filter is another type of adaptive filter. And in fact, there's a very strong relationship between exponentially weighted and Kalman filter. A lot of Kalman filters result in the filtering, the filtered coefficients are exponentially weighted. In some ways, you can have lots more degrees of freedom in Kalman filters. So in our specific example, we're going to look at, say, at Bitcoin and Solana, and Solana is a wonderful coin. It's extremely fast. It can do a tremendous number of transactions per in any tiny time frame, but at the same time, it's far less liquid than Bitcoin. But that liquidity has changed through time. And that's something that, okay, so this is actually the problem with this routine is very, very slow because window size of 500. I forgot to show you how big my data sets were, but I'm going to say I have several thousand, many thousands of data points because it's just so easy to download lots and lots of data. So it's been a little while since I calculated this. I forgot about it. I left it, and now unfortunately I'm calculating again. But I'm just to skip ahead. What's going to be obvious is that the causal relationship has changed, and that Bitcoin did cause Solana historically, but there's less of a strong causal relationship at this point in time. And that's something that that would be obvious once this is done. Essentially, it's doing a series of these hypothesis tests over these rolling windows. You see, we have a 500 data point window size, and I didn't tell you how big the data sets are. I did in this little presentation here, I did one of the worst sins ever. Is when you get your data, the first thing you're supposed to do is to plot it. And I have that in another spreadsheet. I'm sure I have that here. If I go to one of these, that we could probably find some like in one of these, we could probably find something like crypto exploration that probably does actually plot the data. Because and this is something my first boss told me: just plot your data first, just because you don't know what it is. You might actually have downloaded the wrong data set. You might have downloaded. You might have. Maybe the numbers are multiplied by 100 every now and again. I mean, what you'll notice sometimes is the data, there was a mistake in it. I've seen that before. Economics data in Bloomberg that suddenly it was 100.01 and suddenly it's 10,001 for a couple observations, and it goes back to 100.01. There's all sorts of errors that are feasible, and you just have to be prepared you have to know what sort of your tools you have to be able to use to cope with that, because every one of these things can be coped with. I mean, even if it has to be recoded by hand, or there's lots of automatic tools, but you have to know which automatic tools to use, because none of them are costless. Let's see. I'm going to say, and I didn't do a very good job with the multiple y-axes. Let's see. So these are just, and here I just download in this sheet. Oh no. There we go. Something happened here. Oh, I know why. It's because this is a problem that I had. Let me just create this. I actually coded this as, oh, there we go. This is supposed to be a different kind of cell. It got coded as a markdown cell, so it doesn't get executed. So I need to just make these comments. There we go. There we go. Now I download my data. So I could have made this a non-markdown. What was this? Yeah, it's still a markdown cell. Okay, but this is not, and so it's downloaded all sorts of data here, and we got the heads of them, and now we can actually plot them. Oh no! And I said we could plot it. Oh, okay. I did this just a short while ago. Oh, attribute hustle. Okay, what is this? Oh no, and of course it's hidden. Let's see. One way or another, let's just look at some of what we care about more than anything else is what's the size of our data sets. Okay, so here we have it right here. There's 44,000 data points, 44,641. Okay, so 44,000 data points in all of them except, oh, look at this. For some reason, this ADA is just tiny. There's no data in that at all. Like I should just delete it. I'm not sure if the same data set here. It's all saved in. Yeah, let's just go over here. If you go upstairs here, there's this data subdirectory. And the data subdirectory, okay, typically I'd have raw and processed. Raw data is where you're supposed to put all your scrape data, and you download everything as it is on the web. It turns out raw and processed are the same here because the data is just such high quality. But here I start looking at processed data, and this is the data that I specifically have. And it looks like I have so let's do, and clearly some of them are tiny compared to others. Look, that actually some of these are really, this is 1 day data. That's part of the reason. So you see, I downloaded the 1 minute and the 1 day. And I think, okay, so some of these are, and it all gets stored there. And then some Parquet files, because Parquet files are so much nicer than CSVs. CSVs, you have to know what what it looks like at any point in time. Parquet, you can save to Parquet in pandas. You can read from Parquet. Every column is properly typed. You don't have to worry about you don't have to worry about knowing where in a CSV you're actually starting. It's much faster than CSVs. It'd be great to be able to make databases out of it, but it's not a database. It's just a bunch of files. I've seen people try to use them as databases, but then you have to be concerned about how can you take a specific field, a specific time series from this, which is a little bit more of a hassle. Anyway, so let's see, what do we have here? Okay, so our plotting wasn't that successful, but we have a little bit more knowledge of the structure and what's in it, and some of the information. And we did a sample. We could do, let's do this. Let's do, actually, what's it called? I know, it's called, sorry. Let's just stop this. And it's, let's see what crypto data actually is. Yeah, it's a dictionary of data frames. And this is sample for data. And you see, actually, I've used a tremendous amount of Python before, but now I mostly use C++. It's much faster and more robust, I would say. But anyway, this is a sample of the data that I have in here, and some of it's useful, some of it less so. And we only looked at closed data here. Okay, so I'm going to go back and see if this is done. Causality analysis. What's happening here? Okay, that's not it. That's my other copy. Oh, there we go. Okay, and as you'll see, okay, so it's looking at Bitcoin causing Solana, and looking at the time varying properties of it. And you see, for the most part, the p-values are very, very high, but they look, every once in a while they become very low. They go to 0. So as a consequence, there are times when Bitcoin is a really great predictor of Solana, but so lagged Bitcoin is a great predictor of Solana. But there are other times when it's not, and so being aware of that, and when it's not, it appears to be not for some while. So being aware of that Solana's sort of gone on its own way, that's also something worth really considering. The other thing is to note. Okay, so this is only over 2024. I should tell you that when my students did it, we went back, much longer history. What we found was that it's a little hard to tell some sort of trend in this, except that it became very low for a while here. And sorry, this is this is only like 1 month. Excuse me. It's impossible to tell you an actual trend. So in that period, in that little bit of that week, it was very low. If you went back historically, so as I said, my students downloaded millions of data points, and they found that Solana was very clearly caused by Bitcoin. It was very significant, and it failed to be insignificant in the years ago. So I don't know where Solana was launched. It was like it was maybe 2001 or something. No, sorry, 2020, something like that. And that it was but 5 or 6 years ago, Bitcoin very clearly caused it. And now it starts to have its own dynamic, and Bitcoin perhaps is not quite as important as it used to be. And that's actually a really important thing, because that was something that they then put together to create a specific strategy. And it's just a strategy where it's looking at these lead-lag relationships only. I'm not saying that's the only strategy that one should have, because you shouldn't have just one sort of strategy. You should have a framework to be able to develop a range of strategies and be able to put money behind all of them, or diversify across them if you want to. Or on the other hand, is the possibility of putting many different types of features into a single strategy. where some of the features could be these causal features, and some of the strategies could be just like mean reversion features. Some of them could be trend features. Some of them could be some sort of pairs trading features. That all of those together could form a given forecast. So I should tell you that it may sound confusing, but in my courses, we try to talk about all these sorts of things. It's the fact that some people will there are different approaches to algo trading, but people will consider actually having fixed strategies that only work with a couple features, or they would consider a strategy that has a lot of given features that they can add and subtract from as time goes on, or that it can be as a time varying sort of way of doing that. Okay. So the important thing here was that the causal nature changed through time, even over the course of this 1 month. It's not a whole lot of data here, but even over the course of that 1 month. Because the final thing is asymmetric Granger causality, is looking at whether the positive changes are correlated, or is the negative changes correlated. And I didn't spend a whole lot of time on this, but it's in here, and you guys can review it, and you can look at. And is it still executing? Yeah. And whether there's some asymmetry in the causal relationship. Can you forecast down changes to Solana better than you can up changes? Which is both of them are potentially important, because you can go long and short just as easily. But and whether there's potentially different coefficients on the upside versus the downside. Now, I know this, one way or another, this may not seem particularly modern in the terms of like machine learning, but I would be of the view that first of all, in most algo trading shops, machine learning has had a relatively moderate impact at this point in time. There is some impact, and some sort of methods are being used much more often than others, but that it typically is the practice is more firmly grounded in sort of traditional statistics and linear models and time varying models, or in if it's neural nets, it's very shallow neural nets, not very deep ones, partly because there's a whole lot that can go wrong in finance. We've got, as I say, non-stationary or sort of you could say locally stationary signals that have low signal to noise ratio, and as a consequence, you can potentially by putting on the wrong trade, you can lose a tremendous amount of money. So the loss function is different from other places where machine learning has a significant impact. So I've been warned that my high CPU usage is affecting the meeting quality. I'm gonna stop my video and just keep the screen share going, because I think that might help, but I'm not 100% sure. Okay, let me know if something's happened. Okay, so now okay. So now, okay, this is still, I shouldn't have done this. This is still executing. Okay. One or another, yeah, we're going to summarize the asymmetry. It was the goal, and do a conclusion. And the conclusion, basically, I can jump ahead. Is that okay? As far as I know, there is asymmetry. There's some asymmetry. Can you show us where you extract? Oh yeah, sure. I can show you again where you extract the data from Binance. That's absolutely good. And I'll share that with you, because if you go, okay, just for information. So this is executing. If you go, okay, it's going to be, let's see. If you go to my my GitHub repo, you see there's it's github.com Firoozye, Firoozye, crypto causality. I just stuck everything in there. And it doesn't look so nice here. Oh my goodness. My markdown skills are very limited, because it looked so much nicer in my browser than it does here. I'll have to work on that if I really care that much, if it matters to anyone. And and then um, and then this was essentially the homework I gave to everyone when I gave this original project was, can you predict future prices and returns? Develop a trading model based on this information. If it's time varying, use EWRLS or RLS, and I provide that as well. And then, as I say, note that you are only testing a set of features. A real model will include other sets of features, including, some ARMA, some ARMA model features, maybe sentiment features, maybe other limit order book data. Okay, don't worry about writing up a notebook. This isn't your homework, but you can do it if you want to. But and then if it isn't working for 1 minute, you can do it for other frequencies. Okay, now. Okay, so in here, so that's where where everything is. Let's review it ourselves. If we go here, okay, so in here, so in the project root, we have the PDFs, we have the data subdirectory. I can't remember what's some examples. Oh yeah, actually, there's some interesting examples, and there's a little while since I did this at least a year ago, and so some of these examples here do some of these same analyses in a very nice way. They just don't do it in a notebook. But they're examples of how the code can be used. And then I had a results page. Is a time varying Granger causality. TVGC. I believe in one of the statistical packages, like Stata, it's called TVGC. It's just a set of routines you can get up and running. And you see, so here actually I have let's look at this. What does it say? TVGC. Oops. Results. Oop. Oh, it doesn't look meaningful at all, does it? There's no way anyone can discern any pattern from that. Oh my goodness. Okay, so it's clear that there's some time varying Granger causality going on, but that's not very helpful to us. Okay, so I told you we'd look here at the go upstairs, go to source. Oops. So source is where all the source code should be, and then I have the if you look at analysis, let's look at tree. Let's just do tree here. Tree. Okay. So in the analysis, I have I have some Granger causality tests, something I should delete. How to deal with outliers and whether outliers are necessary. Okay, so some of that is potentially interesting. Some stationarity tests, I guess I left them in there, I'd forgotten, and time varying Granger causality. I have my configuration.py, which is used by the data downloader. And data downloader is where I download all the data, all the data from Binance. And it's really, really easy to use. So let's see, I think I have it here. So here's let's see. Okay, let's do there we go. So B7. This is data download. Okay, see, I import the Binance client. It's pandas. Pi arrow is for Parquet. And then what do I do? So crypto data downloader. What do I do? Create a client, which is the Binance client. This is creating subdirectories. Some of this is just sort of, you don't need it necessarily. It's kind of this whole object-oriented nonsense that makes sometimes things easier, but makes it sometimes harder to figure out what's going on. These are the data frame. This is the columns we'll be downloading. And the time and the conversions that needed to take place. And then you see, so okay, some of these things, interval, start date, and end date, I believe they're in config.py. Let's do that. Let's do split. Let's do edit. Oops, what happened here? Oh no, I'm gonna do edit config. Oh, let's do. So I'm gonna do Where did I put it? There's config.py. Okay, and so in this config file, I had all sorts of stuff, and maybe it's nicer actually if you have a project, if you have it in a YAML file or a JSON, I put it in a config. And so you see the time parameters. This is for downloading 1 minute data for that 1 month. I didn't want to muck up my system and download far too much, but it's really easy to do so. And so this is where, as I say, the students at the hedge fund, that's how they started. They used this, and they put in more and more symbols, and they put longer histories. They did 1 minute data. They did 1 second data, and eventually they were manipulating data frames with millions and millions of rows in them, and being quite happy about it, knowing that of course there are limits to what they could do if they have too big data. But yeah, this is really it's a very easy thing to use. Now, there's some things about crypto data which distinguish it from other data sets. Is that it's crypto is what you call it's a small tick market. So there's if you're trading something like Apple or IBM, there's quite a bit of space between the different ticks. So the different limit orders are sort of widely spaced, and there's a tremendous amount of liquidity at each limit order on the bid side and on the ask side. With something like something even like Tesla. Tesla, because of the dollar price of Tesla relative to the different ticks that you can trade, it's very sparse. So sometimes there's the top of book, so the best bid and the best ask may be actually really small size, and you may have much more liquidity deep into the book, and the consequent price action is that it tends to gap. And you see that in Bitcoin. In Bitcoin, the series tends to go along and then suddenly it will gap up and then it'll suddenly gap down. And it's really entirely to do with the fact that when it gaps, it was a large order went through, and it went through all the different it went through many different levels of the limit order book until it finally found peak liquidity. So in some sense, knowing that, it's a very different time series as a consequence. Okay, so this is so that's really all this does. It's just so simple. Okay, so now let's go back to where I was. Let's see if it's finished. Okay. Oh, look here. Okay. So this is lags, and so this unfortunately is a little bit to sort out. Positive and positive change in Solana causing later negative changes in Solana. Okay, so Solana tends to revert in some sense. Negative changes in Solana later on causing positive changes in Solana at a different optimal lag length. But we have the possibility that we can look at all 4 quadrants and seeing what's significant and what's not. And there is some rationale for potentially I say doing a nonlinear regression here as a consequence, where we'd have to create nonlinear features, whether it's positive or negative, and potentially different models for whether it's a positive change in Solana versus a negative change in Solana. It might be possible to do something like that. So now, what do we have here? So summary of asymmetric. So it says that here is that Ada, so Cardano caused Solana, positive Cardano caused negative Solana, but not negative to positive. And that was one of the most significant according to this analysis. You guys can look at it and take a more deep look. Okay. So in conclusion, the script demonstrated how to perform comprehensive causality analysis. And there's a separate script. If you look at here on, there's a separate script but it's basically a repeat. It's just that it's too much to do all at once. This is for downsampled data. Downsampled, or you can just download the 1 hour data, right? So it says the same, but it's got the 1H there. And it's basically looking at 1 hour. And I can't remember here. So I resampled the data at the 1 hour. So you have to have lots of 1 minute data to make the 1 hour data significant. And it turns out that the significance is a little bit easier to establish as according to the paper. And so I haven't had a chance to look at it to show you, and unfortunately still stuff to go through here, is that all this can be used in a forecasting framework. And the forecasting framework, I just barely put this together, but it's basically it's using exponentially weighted recursive least squares. EWRLS is used a lot in signal processing. It's very, very fast to update. There are some hyperparameters that can lead to instability, but you can make it very stable. There are other ways to make it more stable using what is it? QR decompositions or something like Cholesky decompositions. It's just more numerical and linear algebra. Make it stable under all circumstances. And essentially what we do here is we create some features based on the lags. And that from the lags we can then decide, because we're picking and choosing which are the right features to add in, we can do forecasts at lots of different horizons. Forecasts, sorry. We can do one period ahead forecast using our rolling, our effectively like our windowed regression, where we our windowed regression, so where we're updating our betas every time period, and that's essentially what an EWRLS does. I didn't give references here, but I will, and if you're interested, I mean, it's called adaptive filtering. If you look up adaptive filtering, you'll find lots on it. So these are some. I should tell you that these are some of the things that if you're interested, I have here. Oops, let's see it back here. Well, that's not it. Okay. Let's go to the very bottom here. Excuse me. So further references, just for there's a link tree that I showed you guys before. It's just over here. It has links to everything. I try to make everything connected because it's a little bit easier. The personal page and blog, these are going to be changing. The blog only has one entry in it. It's about non-stationarity. I'm going to do further work on non-stationarity and mean reversion trading in the blog. And then I just wanted to tell you about two online classes that I offer. One is just sort of an intro. It's a fundamentals of algo trading. It's at Quant's Hub. That's something. It's sort of self-guided. The pre-recorded lectures, as well as a repo for analyzing trading pipeline in general. And the goal here is not just to give you a single strategy, but to talk about the pipeline and how the pipeline works and how you can discover more and more strategies. And as well as in the fundamentals course, I talk a little bit about what algo traders do and the different roles for algo traders. So a lot of people with, especially with STEM backgrounds, or or even those who have gone on for master's degrees in quantitative finance, they're not really aware of all the different areas of algo trading. And a lot of times people do quant finance, they're like me, they think they should be just doing exotics, right? Pricing and hedging exotics. And I've done a fair amount of work in exotics, but I'd say that there's a whole industry out there that doesn't necessarily trade exotics and illiquid stuff like that. It trades highly liquid things, but uses statistical methods for doing so. And I say and so in this fundamentals course, I talk a fair amount about the structure of the industry, the different aspects, some of the different players within it, but it's quite a big industry, and there's high frequency, there's mid frequency, and there's this lower frequency or factor-based trading as well, and many different other flavors of it. As well, we have a hybrid course called Algorithmic Trading Certificate. That's offered, I believe it's in September is the next date. We had amazing cohorts in that. It's typically a very small class. It's similar to my UCL class, but um, it's typically a smaller cohort, and so it's much more intense. It's a 12-week course, and that's offered again through WBS training, as is this Quant Hub or WBS training. They're both, I'd say that they're both worth exploring if you're interested in some of these things. And I said, both of these, so all of this analysis, even though I'd say it's not fully complete here, I'd say it's further homework for you guys. But it's all of it can be fit together into, and so as I said, we were exploring features here. What's a good feature and what's a bad feature based entirely on this Granger causality test. And I'm not one to believe that you have to have exactly one way of doing that. Hypothesis testing is the only way to go, but it's informative nonetheless. And so you may not have to be a sort of strictly believing in statistical method, but there's a lot to be gained by getting some information out of it. And then based on that information, we establish, in this little forecasting model here, establish some various different causal features, and then fit an EWRLS model, exponentially weighted recursive least squares model. And that's something that's in here as well. That's something so EWRLS, let's see here, something's going on with my screen. Let's see. Let me do Control N here. This is under source data, EWRLS. Okay. This is something I've used quite a lot of times. So there's okay, why do I have so many of these open? Okay, this is the EW, yeah. Okay, so this is the exponentially weighted recursive least squares with a ridge regression term, a regularization. And so it's something worth looking at if you're interested. It's actually very similar to a Kalman filter. And so I should tell you, just sort of to wrap it up, because I know we're getting on an hour, that my students then did this kind of analysis and were able to easily get, doing daily trading, a 2+ Sharpe ratio strategy, where they only traded the coins that were caused by other coins, and then they flipped out of them and as soon as the causal nature was sort of the causal relationship decayed, they stopped trading them and they started trading the less liquid ones. But as long as the signal came from the more liquid all the time, and then it was very easy for them to sort of establish a very, very good strategy based on that. And it had to vary through time because, as I said, the coins are introduced, they are caused by other coins, and then as time goes on, the causal relationship breaks down, and but there's there's newer coins that are out there ready to be traded. And stay away from the really dangerous ones, of course, but ready to be traded, and those ones will be caused by the liquid ones. And that kind of dynamic continues again and again. Okay, I think I don't want to carry on too long because I've carried on very long, but I just wanted to give you that kind of heads up and give you some resources. And I'm sure that with Tribhuvan, or if you have questions, I'm happy to answer questions at this point in time. And maybe Tribhuvan has some more words as well.
I'm audible, guys? Yeah, I'm audible?
Hello.
Yeah, I'm audible? Hello?
Hello.
Nick, can you hear me?
Yes, I can. Hi, Tribhuvan. Yes, I can. Oh, something's happened. Here, I'll tell you what, I'm going to turn this off again. Maybe I've slowed us down. Okay. So there's a question here that's quite interesting. How is this helpful in live trading? Like X moves Y, but by the time X moves, Y would have also moved as per. Okay. So, we're talking about a lag of a couple minutes. If your model takes an hour to generate a forecast, it's not helpful at all. So you just have to have a model that's fast enough to take advantage of this. And yes, it is. It is, and people do these kind of strategies all the time. It's and So sort of causal strategies. Oftentimes they're not necessarily dynamically changing them, but why don't we use VecM to get more long-term relationship for Liga? Okay. So 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 we used vector error correction is like co-integration, and co-integration is establishing. Okay, it establishes a long-term causal relationship. Yes, in some sense, the co-integrating vector tells you a causal relationship between the underlying variables. Co-integrating vector is like a fair value model, and yeah. So I'd say that in general, if you want to fit an entire model, it's oftentimes, especially if you're looking at a given sector, so like a sector in equities, for instance. It's interesting to note, the some sort of long-term relationship between the underlying equities, some sort of error correction, if they are in fact co-integrated. And then, as well, because any kind of error correction or vector autoregressive model can have lots and lots and lots of coefficients. It's very helpful to force some to zero. And this is a method for deciding which ones you're going to zero out. So I did as well answer part of that question, that it is valid for other sectors by all means, for futures, for equities, for forex. There's less liquid and there's more liquid, and it's just a very common thing. Is that I'm going to say that a tremendous amount of hedge fund activity is looking at is trading less liquid stuff that based on how more liquid stuff does. And you think about it, even from the point of view of when people are trading the basis, the treasuries, the treasuries future basis in hedge fund land. Part of the reason for the market meltdown during COVID, I think it was 2020, was primarily that the hedge funds had very, very large leverage positions in bonds. The bonds trade differently from the futures. The futures are much more liquid. So the futures are more liquid. The clients like to trade the futures because they're just easier to trade. The hedge funds trade the bonds versus the futures, and so that liquidity differential is a driving force when it comes to a lot of algo trading and hedge fund activity in general.
Sorry, Nick. Actually, I think there was some network issue from my end, so I was not able to say anything in between. Can you? Am I audible now?
Sure, please.
Yeah. So, I think other people who have questions from like if you want to ask questions, you can just put in the chat. If you have any questions for Nick, or you can unmute and ask the question to Nick if you want to. I don't think so. Okay. So thank you. So I think we can wrap it up, Nick.
Okay.
Yeah.
So
Guys,
please,
yeah.
So please have a look at the online resources I've supplied. As I said, if you're interested in further any of the online classes, which may be of interest.
Yeah. So what I will do is, Nick will share all the links with me over mail, and I will circulate to all the people who have registered for the webinar through the mail for the course link and other resources which Nick has shared in the webinar, and I will mail it to all of you. Does it work, Nick?
That sounds great. That sounds great. I'll give you those two links to the GitHub repo and the two different into the courses. Hello.
Yeah. Yeah.
Okay. I will send.
Yeah. I will circulate all of them. I will circulate to all of them and share it with them.
Good.
Am I audible, Nick? Hello. Yeah.
Yes.
So I think we can wrap it up now. People learned a lot.
Okay.
And I will share all the links with the participants.
Okay. Sounds very good.
Yeah. Sounds good. Yeah.
Okay.
Okay.
All right. Take care now.
All right.
Thank you.
Take care.
Okay. Bye-bye.